Hi guys, Robert Wolf here with Terra Firma Business and Financial Consultants. So today's topic is we're going to talk about the three main financial distributors. What's that mean? So there are three main distributors of financial product, if you will. So you have the banks, you have investment companies, and then you also have insurance companies. So banks represent leverage. Okay, so what's that? What do we mean by they represent leverage? Well, have you ever gotten a loan before? So if you've gotten a car and you got an auto loan, what did you put down? Very little, right? But you did borrow a lot. So that's what we call by leverage. Home, real estate is a great example. So they represent leverage. Now, according to the Federal Reserve, they're only allowed to, or not only allowed, if they have 122 million, they're able to only have 10% on hand as surplus or reserve or liability, what they call it. What that means is that, let's say you have $100,000. You deposit $100,000 into the bank. It's a savings, CD, checking out, whatever the case may be. They're allowed to loan out 90% of it, just have to keep 10%. So $10,000 they have to keep in reserves. The other $90,000 they get to loan out. So what are the interest rates that they're charging? Well, you obviously look at your financial statements and you can see what kind of interest rates they're charging. What kind of interest rates are you getting in return? As you can go ahead and look at that and see so who's really winning here? They are. So that's really where the leverage comes into place. Now the products that banks offer, with checking, savings, CDs, HELOCs, home loans, that kind of stuff. HELOC meaning a home equity line of credit. So that's an example. Now, investment companies represent risk. What that means is that within investment companies, they're able to invest in other companies, help companies become public. There's no guarantees, and it says it on if you invest in a mutual fund or ETF or any type of stock bond. Vanguard's a great example. Vanguard has an S&P 500, their ETF or their mutual fund, either way. But on there it says that past performance is not a promise of future results, that you could lose more than what you put in, that your gains are not guaranteed, nor is your principal guaranteed. And so it tells you that. So they represent risk. Okay, now we know that by risk and reward. So if we want to take less risk, then we have less reward theoretically, right? If you want to take more risk, then you have theoretically more reward. Okay. Now, insurance companies represent safety. So what we mean by that is what happens with with insurance companies is that every state is governing their own insurance industry. So the insurance commissioner and all the states get together and they're part of the National Association of Insurance Commissioners. They have their own association group and they come up with standardized rules. So basically what the federal government would create, they create together. But each state is responsible for their own insurance industry, if you will. But in the state of California, we'll use that as an example. The state of California, according to the National Association of Insurance Commissioners website, they're required that if they have $2.25 million in capital, they're required to have at least 100% of capital. Okay, so basically dollar for dollar reserve based on that. So now most insurance companies and all insurance products, the state of California requires 100%. Now I will say most A-rated or higher insurance companies have a higher percentage than 100%. And part of the reason being is that they're allowed to invest those reserves. So they know their claims, right? They know their numbers, actuarial numbers. They know what their losses potential could be in one year to the next. And so they have those set aside as payable claims, right? In short-term cash equivalent, if you will, okay? Now everything above and beyond that can be invested. And so in those returns on those investments, they get to keep and recoup, okay? It's called investment income for them. So now here's the key about these distributors. So we know investment companies offer stocks, bonds, mutual funds, ETFs, derivatives, alternative investments, and the list can go on and on, right? Insurance companies offers insurance products, right? Home, auto, disability, long-term care, life annuities, and so on and so forth, okay? Health insurance. Now, here's the key. All three of those industries use each other's products. So if they are, why aren't we? Actually, the greatest owner of life insurance really are banks. they purchase banks because of the safety. And so the banks purchase life insurance on their executives and so on and so forth. It's called bank-owned life. But we'll talk about that at another time. But it's interesting. Think about it, what those three distributors are and how your particular situation looks. And maybe you can diversify in one of those, or maybe you're too heavy in one of them. So anyways, have a great one. Thank you so much.